in the market, they send the traders on the wrong side. That's the Judas swing. That's the run on price action that gets people thinking, this is where it's going. I want to get on board, and they chase it. And if they're initially positioned to profit while it's forming, it gives them a sense of like comfort when you shouldn't be comfortable. It's usually the wrong side of the marketplace. And then it comes down, takes the low out. And remember I was asking, do you feel safe if your stop was here? That's me priming you. I'm priming you as a student. Okay, he's taking my attention up here. And I said, now what about the people that had their stop loss here? Who's made money right now? Shorts. Anyone long from that low is now unseated. Why did they do that? Because they're going to go here. So to run from here to here is profitable. To run from here to here is profitable. And why it went down there is to unseat the stops that were resting right below that low. I took your attention to this area here. Told you the fair value gap was going to be there before that candle closed. One tick below this candle, that's the institutional order flow entry, Joe, and we don't want to see that entire gap closed in. That gap looks like this. That's your fair value gap. It went down to this low. Is that still unfilled? Of course it is. That's exactly what you want to see as a signature. But these things that will repeat over and over again in price action. The logic of waiting for the sell side and the buy side, once you define what they are, just wait for the first one to get taken. When that water is disturbed and you see violence, jagged, 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 the whole time, these are smooth and this is smooth. Oh, I want to be able to buy down here. Well, when it goes below that, you buy it then. Learn from that. Sometimes it'll be great. Sometimes it won't be. We want to see it trade above the new day opening gap. That means I'm saying that once it gets above that and it starts to trade here, as long as we don't breach that midpoint of that wick right there. Why? Because we've had the stops run below that low in here. So this movement is what? It's a wick on a higher time frame. It just doesn't look like one. It's wicking here to take us below that low and that low. So this low is the low that forms what? These relatively equal lows. And it's also being respective of the new day opening gap. See the bodies? Is this one doing it? No. Oh. See, that's logic. That's logic. I'm not going to refer to this one as we go back above it as support. I'm going to use this one because this one here is already showing that it's done what? It's respected it. So the algorithm is going to go back to that one. It's not going to refer to this one. Which one was on the new day opening gap? And the bodies are showing it right there. So now my attention was focused there. We went above it. I'm going to see it trade down, touch the opening. I'm sorry, the new day opening gap high. And it can trade as low as that low one, but we don't want to see it close below that wick of that candlestick's midpoint or consequent encroachment of it. And it only gave us a touch of the high of the new day opening gap, rallied, showed displacement. Wonderful. Next candle as it's forming. This is going to be a fair value gap. Called before it formed. Institutional order flow. Called before it delivered. I was off by 2 handles, 8 ticks, or thereabouts, or 7 ticks. Would it be 7 ticks? We'll just call it 2 handles. It did not close in that gap, which is exactly what I told you. That's ideal. And then it's off to the races.